Welcome back to our YouTube channel. We have a very exciting video for you today. We are going to talk to you about some additional metrics we use when we're evaluating stocks to purchase.
Smash that subscribe button, give Bert and I a thumbs up, turn that mother sucker blue. We want to try to boost up the community and how many people we can reach out to help you on your journey to financial freedom. And today, as Bert said, we're going to talk to you about two other stock metrics and balance sheet metrics we like to look at when evaluating a potential stock to buy for our own stock portfolio.
Yeah, perfect. So the two metrics that we're going to talk about today are number one, the current ratio, number two, the quick ratio.
Now, again, these are going to be a little bit of an extra dividend metric or, again, a balance sheet metric that we like to look at in addition to our Dividend Diplomat Stock Screener. So those are three metrics that we look at, but these are going to be an additional two. And really, when you think about a company right now, even as an individual, if you're going through a pandemic and you had a poor balance sheet with high levels of debt, more than likely you were going through some pain during a financial crisis time period.
Yeah, these metrics are geared towards helping you evaluate that balance sheet to avoid what Lanny was saying, those dreaded dividend cuts.
Right. Now, to really start to get into it, first, what is the balance sheet? Your balance sheet contains all of your assets and all of your liabilities and equity. Liabilities are your debt, your assets more than likely are your cash, investments, receivables, and we won't go into the different industries from a balance sheet standpoint. Then, what is the current ratio?
Yeah, current ratio measures your current assets divided by your current liabilities. So when we're talking to our balance sheet, there's a big difference between your current assets and your long-term assets. Current assets are assets that are 12 months or less, and current liabilities are bills that are going to be paid when you're due in the next 12 months as well. So this is really looking at your short-term assets compared to your short-term liabilities to see what's left over and if you're in that net positive position.
Now, the quick ratio, you might be wondering, why is that different than the current ratio? Well, the quick ratio, if you're in more of the manufacturing or something that actually produces goods, your quick ratio takes that current assets on the balance sheet and subtracts out inventory, something that's a little bit more difficult to just churn and sell.
Yeah.
So if you take your current assets minus your current ratio, your inventory to get to that number, and then you divide that also by the current liability. So that's really how fast can you pay off your current obligations.
Yeah, so what's that golden number that we're looking for, Lanny? When you're measuring a company's current and quick ratio, what do you want to see that end result output?
I'm stubborn. I want to see a current ratio over 1. And then from a quick ratio, I want to see something, obviously in a perfect world, I'd want to see over 1, but I like to at least look at over 0.5.
Yeah, so a current ratio of over 1 indicates that a company has enough current assets to cover their current bills over the next 12 months.
What about you, Bert? Any metrics that you use?
No, I mean, I think those two are the two major ones that I take when I'm looking at a company's balance sheet. And to me, I really love looking at that current ratio. I love adding in that advanced metric when I'm screening a stock to make sure that a company is liquid enough to cover their bills.
Yeah, so after you've gone through the Dividend Diplomat Stock Screener when evaluating what stocks to buy for your portfolio, take it one step further and take a peel back at their balance sheet to see if they, can withstand volatile time periods, to see if they have enough current assets to cover their obligations. And I continually update this almost on a quarterly basis as companies release their, their financial condition. A good example is Cisco. Right now they have over a 1.8 on their current ratio and even a 1.7 plus on their quick ratio.
Man, that is impressive.
It's very impressive in my eyes. And then you can even take a look at, a company like UPS, for example, who obviously have had a tear in the stock market recently.
It's incredible what that company has done over the last few weeks.
And they even have a current ratio that is far above 1 at over, I believe, 1.8 as well, with a quick ratio that is above 1.
Yeah, it's incredible. Again, so you can see these companies have great short-term balance sheets as well. And that's a huge metric to look at, and it's just another measure for just to assess the quality. We'll just keep bringing it back to that point.
and after a company passes the Dividend Diplomat Stock Screening metrics, such as Aflac, Bert's favorite duck.
Oh, Aflac.
Bert almost missed the cue there.
Yeah.
But they have a current ratio, again, of above 1.2 and a quick ratio over 1.1.
So again, as you can see, these aren't the only metrics we use to find stocks. These are just great bonus metrics that help you further evaluate the company and help you finally make that decision of what stocks you're going to buy.
And then poor examples would probably be big oil, where their current and quick ratios were far below that 1 mark. And as we've seen, they've had a lot of dividend cuts, such as, Bert's favorite oil company most recently.
British Petroleum.
Yeah, what happened, Bert?
They just slashed their dividend by 50%.
Yep. Which actually isn't as severe as what Shell did, back in the, early parts of, Q2. So, companies that weren't liquid enough, that were really strapped with debt, had to cut their dividend during this crisis. But the companies that were liquid enough, can either maintain their dividend, increase their dividend, but, more than likely they're feeling okay because their balance sheet is far less risky and they're far more, flexible to make moves during a pandemic.
Yeah, so again, these are, just to summarize, 2 additional metrics that we use, 2 that we particularly like. They're not the end-all be-all for an investment decision, but we like to look at them with each investment. So please let us know in the comments section if you evaluate the current and quick ratio, and please tell us, do you use a threshold different than 1 for the quick ratio? I believe you said 0.75 for the quick ratio?
0.5 to 0.75
Oh, I apologize.
plus.
Yeah.
And if there's another, balance sheet metric that you like to use, please definitely share that with us and the other viewers as well.
Yep, and if you like this, like our channel, like the videos we continue to produce, don't forget to subscribe to our channel and give all of our videos a thumbs up. So, and again,
do it. Do it.
So,
do it.
do it.
Again, this is Bert and Laney from the Dividend Diplomats.
Over and out.